Hey everybody, it's Daniel here from inventories. Hope you're all doing well. So in my last video, we talked about the Canadian housing market and how the inventory is rising in that country, but rising not because of demand for houses, rising because a lot of these builders are looking to build rental units because nobody's buying. And the condo market in Toronto and Canada is getting worse off, and the unemployment rate is getting worse off. Now, what about the neighboring country like the US? Is that also, are we seeing some weakness in all of US's housing market? Well, it depends where you're looking at. Certain metros are doing better than others, and the prices are holding up, and the inventory is holding up there. When you look at certain locations like Boston, New York City, they're doing better than many of the other states and cities in America. But it all has to do what happened during COVID, where a lot of people flocked to these certain cities, to these certain states, and are now realizing that they may have to go back to work, or they may realize that they don't like where they're living and they're planning to maybe move back. And in many of these metros also, inventory is rising quite rapidly in those areas, and which is also putting downward pressure on the housing market there. We're also seeing days on market rise for many of these top worst performing metros at year over year, as rates continue to be higher, uncertainty about the market, the job market, and also that many people don't want to sell either at a lower price, or are hinging and holding on to the idea that they could maybe sell back at that 2021 price levels before the prices peaked in 2022, right? Still holding on, hoping that they could get some sort of bang for their buck and make a profit. But that's not looking like the case, especially as there's no one really out there looking to buy, unless there's a specific reason of moving and job changes and etc. I totally understand that. But when you look at the overall market, it's not the case, especially when you look at inventory rising and the demand weakening. So let's take a look at the study done from Realtor.com. Basically shows a map and discusses about the 10 slowest housing markets in the US. So it talks about here, the housing market is showing signs of losing some steam this summer. The slowdown is especially evident in two regions that experienced construction booms in recent years. Researchers at Realtor.com analyzed housing data to identify the major metros that have seen steepest drops in home sales activity. To do so, experts looked at how many additional days a typical property waited for a buyer in June 2025 and compared that with last year. The top 10 metros were ranked by the largest year-over-year change in median days on market. Notably, 9 of the nation's 10 most stagnating metros are in South or West. Topping the list is Nashville, Tennessee, where typical listing in June lingered unsold for 20 days longer than a year ago, with the median days market climbing to 52. Miami came in number 2 with homes there waiting for a buyer for just over 2 weeks longer compared with June 2024. Right? So nationally, homes spent a median of 53 days on market last month, and there's many other states and metros which we're gonna look at here that gives you the details. So what Realtor.com has done is they looked at the year-over-year change here, and they're basically ranking them from the worst year-over-year change to the better ones, the top 10 basically. All right. Now they're all not amazing, but Nashville, Tennessee saw 20 in terms of the year-over-year change increase on how many days on market homes are being unsold for. So Nashville came number 1, Miami, Florida came number 2 with 15, Orlando, Florida came number 15 here. Number 4, we see also Arizona and Jacksonville, Florida being in the 12s. We see Columbus, Ohio, 11, and so on, right? Now, when you look at these numbers, it may look small to you, but when you look at the median days, that properties have been unsold for, you see Miami, Florida quite high, right? The market there is definitely in trouble with 83 days there. Orlando is 70, right? Jackson, Florida, 67, Nashville, Tennessee. And these were areas that a lot of people flocked to and during the COVID pandemic. Now, why is this happening? Why are we seeing this rise? Didn't we see some sort of rate cuts also in the US? Although, yes, we are on a pause right now in terms of rate cuts. But didn't we see some sort of a cut before we had that pause? Shouldn't this be fixing the market and fixing the housing market? Well, not necessarily, right? Those rates that are on pause is not enough, and those rate cuts that we saw doesn't really 100% affect your mortgage rates out there, because a lot of that in the US is influenced from the US 30-year bond market. And those bond yields, we've been seeing those yields pick up and the bond prices sell off due to many reasons, and the trade war and tariffs and fiscal deficit and so forth, that caused those bond prices to move up and those yields to stay high. That's why you're seeing those rates higher as well. Now, although the job market in the US is more resilient versus Canada and other places as well, it doesn't necessarily mean all things are good and hunky-doris there. Right? We are definitely seeing some sort of weakness when you dive into the numbers, when you look at different reports like the household survey report versus the establishment report. When we get those jobs numbers coming out, we are seeing a stagnant growth there and not much change there in those numbers. We are also hearing from a lot of tech firms laying off as well. So it is affecting certain areas, certain markets, and the market is somewhat on a standstill, which is also not good for the real estate market. Now, when you look at also the markets in terms of cyclical and defensive, you're seeing cyclical markets and stocks, like for example, more of like the tech, you're seeing crypto, you're seeing a lot of the risk on sentiment pick up steam, versus the defensive, like your healthcare stocks, your real estate stocks, the real estate market, utilities kind of lagging behind, which is basically telling you a sign that money is flowing towards more of the cyclicals, more towards taking on more risk, versus the other markets like real estate and so forth lagging behind and underperforming due to, again, higher rates, due to prices still elevated when you go and you see in your groceries and whatnot, right? So they want to combat investors want to combat inflation and take on risk because, one, money has been sitting on the sidelines for a long time. Number two, rates do affect defensive and also the more of the real estate side of things. And number three, they want to combat those higher rates, those higher inflation prices with more of the risk on assets and the cyclical assets out there so that they can get some sort of return. So you're seeing that in the market, certain areas do better than others, which is a telling sign of risk on sentiment. This can definitely all change when we start to see maybe possibly a lot of people get into the market too late, when maybe if there is some sort of black swan event or something, and then it causes investors and traders to be more defensive, which means piling into defensive plays. Now, initially, we might see a pullback on everything in terms of all asset classes, but then you will see a pick back up in more defensive plays if there were to be a scenario of some sort of black swan or a risk event that comes down the road. So anyways, it was very interesting to see this from realtor.com, and it's very interesting to see since 2022 the housing market has been just on standstill. It's going to be very interesting next year when we have a new Fed chairman. What are they going to do when it comes to interest rate cuts? Are they going to listen to the Trump administration? Are they going to follow them and fall into their pressure of cutting rates and doing so quickly? And how will the long end of the bond market react to this if they're cutting rates too early? If they believe so, they're cutting rates too early, will we see those mortgage rates still stay up high if there's no some sort of major risk on event, or will we not? That will be an interesting question to really analyze and see how it plays out, because it's not straightforward and there's a lot of variables in the scenario here. So until next time, I'll see you guys later. Hope you guys have got something out of this. If you want the link to this article, I'll put it in the description for you to read up on it. Let me know what you guys think as well. Leave a comment, subscribe, hit the like button and bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.